Slight delay here. We'll just start this thing going right away. We have another webinar presentation provided to you by Path Trading Partners, Bob and Mike again. Actually, this one is going to be a two-part series. They overdid themselves and have quite a few slides, so we're just going to break it up. Anyway, and also it will be next week, same time on Tuesday. So there's a lot of good stuff again. So I'm not going to sit here and tell you all about it, but please send your questions in to me. I'll make sure that Bob and Mike get them, and we can just dive into it right now. Okay, Bob and Mike, go ahead.
Can you guys hear me okay? You should be able to hear me this time. All right, that's good. Mike, you can hear me? Mike, are you there?
Yeah, I can hear you, Bob. You're good.
All right, good. So this is class 4 of the Nadex spread presentation we've been giving through the North American derivative. Again, thank you guys for being here. This is going to have a lot of information. As Chip said, we decided last second to break this down into 2 parts. So we're going to have another one on Tuesday, same time, Tuesday next week, that will take care of the rest of the Greeks. We're going to go over 2 of the Greeks right now, and that should take care of sort of the base of what you guys need to know for the Greeks. So as always, I want to go through a risk statement. This presentation is for information purposes only. It does not constitute investment advice nor offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only, as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial conditions. Past performance is not indicative of future results. Mike, if you could, it's echoing. Can you mute your side over there, please? All right, we taking care of the echo? We have. Okay, good. All right, so again, I've gone overboard on this disclaimer, and I just want to take 5 minutes and do it again because it is really important. It is not just, the abbreviation would be CYA, but it's not just cover your butt kind of stuff. Okay, one of the things we really like about the North American Derivative Exchange is that they're able to tell you your risk before you get into the trade. So down the road in some of the other stuff we do at Path Trading Partners, we'll be talking about how you don't have to necessarily wait to expiration and sort of cut things out as they expire and take the full risk, but it does limit your risk to the amount of money you paid, the debit spread, or the debit that you paid for the spread, as we talked about before, short or long. All spreads in Nadex are vertical debit spreads. You do pay for them, but you can't lose any more than you paid. So in some of the stuff we're doing in Path Trading Partners down the road, we'll show you how you don't even have to take the full risk that's calculated on your Nadex order deck, but you can. So I'm going to move forward. And again, we have a slide describing what Path Trading Partners is. I'm just going to go ahead and populate this slide and read them off really quickly, but I don't really like what we do here to be a commercial for Path Trading Partners. But we are a trading and education firm. We're a trading firm first. And our mission was to form a firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path, hence our name. I'm going to go ahead and leave this for a second. You guys can read this if you want. But the main thing that we look for is trades that are dictated to us. We don't look for trades. We do our analysis, and the trades are developed through the analysis. That's sort of what we're all about. Mike Arnold's bio, 23-year plus market veteran, teaching traders online and in person for 10 plus years. One of his other roles is strategy and development consultant to multiple different hedge funds. He's a former options market maker on multiple exchanges, which makes him very valuable to this process because the North American Derivative Exchange, Nadex, is an options exchange. He traded in Chicago, New York, Switzerland, and Canada, and he's a current head of technology and trading system development for Path Trading Partners. My bio, it's up here. It'll be on the recording. Excuse me. So here it is. You guys can read it later. I don't really like to spend a lot of time talking about myself. So moving on. Prior class review. In the prior class, we covered the concept of moneyness and how to know if a spread is in the money, at the money, or out of the money. And this naturally leads into the concept of spread premium and intrinsic and extrinsic value. If you don't know what that is right now, if you're a new attendee to our webinars, you can go to Nadex's YouTube channel, look under webinars, and look for Path Trading Partners. The prior 3 webinars that we did, we went through a foundation, and then we got into intrinsic and extrinsic value to explain what that was. We looked at how to determine both intrinsic value and extrinsic value and the components that make up extrinsic value. And we also looked at the null point of Nadex spreads, where a spread is in the money but does not have any extrinsic value. Very important to know where that null point is and how it applies to your trading. In this session, we're going to build on the concept of intrinsic and extrinsic value. We will learn how the spread price moves in relation to the underlying. What is the underlying? It's the indicative. Okay? When you look at a trade and you see the indicative index that is based upon, that is what is the underlying is. It's the underlying commodity or security or index that the price of the option is based upon. We will learn how time until expiration and volatility affect extrinsic value. And in order to do this, and I know you guys are going to hate this, this is a lot of information, but we're going to examine the concept of the option Greeks. The Greeks are derived from the option pricing model. They help the trader understand the way an option will react to different factors, including changes in the price of the underlying, volatility, time, and interest rates. So the interesting thing about that, if you come from a background of trading just underlyings, like trading S&P minis, or trading crude oil futures, or trading in Forex, all you have to worry about when you're in a trade is, well, I'm long, it moved down 2 ticks, I've lost 2 ticks. Well, I'm short, it's moved down 2 ticks, I've made 2 ticks. That's not the case in options, and again, I think one of the things that's lost on people when they come into binaries or spreads is understanding that they are actually options. So the Greeks actually are important. Whether people want to take time to teach you the Greeks or not, to me, you guys have to understand what you're trading in order to be successful at what you're trading. You would not launch a business without understanding the business you've launched. Trading is the same way. Nadex has some of the best products out there for the new and the novice trader and the experienced trader alike. I mean, I've been trading for over 23 years, and I've started to fall in love with these products. These products are good. These are actual exchanges, and Nadex is CFTC regulated. So they're one of the legitimate ones out there. But you have to understand what you're trading, and that means you'd have to take a little time to understand what the Greeks are. Since you've already learned that Nadex spreads are constructed using option pricing models, we'll investigate how the Greeks can be applied to Nadex spreads. Do not worry if you don't understand everything right away. You don't need to master the Greeks to trade the Nadex spreads. I'm going to repeat that. Do not worry if you don't understand everything right away. You do not need to master the Greeks to trade the Nadex spreads, but you do need to know what they are. You do need to be aware of them. Okay? The major Greeks from the option pricing world are as follows, and they're going to sound like frat houses for those of you that aren't familiar with them. They're going to sound like fraternity house names. But it's delta, gamma, theta, vega, rho, and as a spread trader, we'll mostly focus on the delta, theta, and vega. A spread trader will focus on those three. And again, I'm going to repeat the line from the previous slide. Don't worry if you don't understand everything right away. You don't need to master the Greeks to trade Nadex spreads. Okay, very important that you understand that. We can apply these Greeks to Nadex spreads. The definition of each Greek is as follows. Delta is the sensitivity of the spread price to price changes of the underlying. Okay, so what does that mean? The delta represents how much the price of your option will move in relation to how much the price of the indicative index moved. All right, the easiest example of delta, okay, is if something has a 50 delta, that means it will move half as much as the underlying. So if it has a 50 delta, if the underlying moves 2 ticks, the option will move 1. That's the simplest way to understand delta. Okay? Gamma, the sensitivity of the delta to the price change of the underlying. Now here's where it starts to get complicated, right? So the delta dictates how much your option will move relative to the price of the indicative index. Gamma dictates how much the delta will move in relation to price changes of the indicative index. So it's not just the price of your option that moves, it's the delta of that option. So if the underlying is moving against you, if you're long and the underlying is moving lower, your delta will decrease based on the gamma. Okay? Theta. Theta is the sensitivity of the spread price to the passage of time. This one's going to actually be really, really important. Okay? This is going to be really, really important down the road in terms of when you place particular trades, and it's especially important in terms of the strategies that we're going to be teaching in VAP Trading Partners. So theta is something that you're going to really kind of enjoy, because you're going to be able to figure out more or less the best times for you to place trade based on that. Okay? Stella just asked, speaking of the Greeks, they have a complicated system in many aspects. So if I don't necessarily have to know how to calculate, analyze them, what exactly is your definition of awareness then in order to trade the spread successfully? Stella, we're going to get to that, okay? And we really go into it in our strategies as well. But theta is a great example for your question, because we'll be telling you the best times to put on certain trades, all right? When the market is moving in a certain way, you're going to need to know when the best time to put that trade on. Everybody thinks that with spreads, the risk reward is the only factor to look at, and it's not. So that's really what we're going into. But we'll get into that a little bit more, Stella. Hopefully that answers your question, at least temporarily. Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. Okay, that's also very important. The implied volatility changes all day long. And Stella, this is a good example of something that you need to be aware of. You need to be aware if your vol is changing. So if the volatility of the underlying is changing, if price is expanding in an indicative index, it's moving in a wider range. That's a and it's moving quickly. That's a representation of expanded volatility. So Vega will tell you the sensitivity of the price of the spread you're in based on whether volatility is expanding or contracting. So you don't need to know how to calculate the Vega, but you need to be aware of it, right? We're not going to focus so much on that in terms of spread pricing, but it does have an effect. Rho is the sensitivity of spread price to changes in the interest rate. We are going to deal with that almost not at all, because it doesn't really apply, because all of the Nadex spreads that you're going to be trading for the most part are very short term. So we don't necessarily we don't necessarily need to follow that so much. All right. Stella, let me know if I sort of at least addressed your question. We will not be looking at Rho since we're trading the spreads. I just said that. We'll not be looking at Rho since we're trading the spreads on a short-term basis, and Rho will not affect the price of the spread the majority of the time. So the Nadex spread Greeks. You should now be familiar with the extrinsic and intrinsic value of a Nadex spread. Again, if you're not, go to the Nadex YouTube channel or go to Path Trading Partners and watch the replay of the previous three, and you'll get a familiarity. Hopefully you guys were watching those multiple times because, again, all of our webinars will have a lot of information, and it's stuff that you sort of need to get a handle on. You may have also noticed that the value of the spread does not move in the same way as the underlying instrument. So if the underlying instrument moves in your direction 10, 12 ticks, and your spread hasn't, you've obviously noticed that, right? Stella just said it makes much more sense now. Thank you. Appreciate that, Stella. Excuse me. This is due to the spread being constructed from options and can be explained by the Greeks. Okay, again, this is another thing. When you look at Nadex binaries, you're always looking at it from a perspective of 1 or 100, all or nothing, right? And the spreads, you're looking at it from floor price and ceiling price, but they are options. So understanding the Greeks, understanding that the spreads are constructed from options, this will all be explained to you by understanding and being aware of the Greeks. Pricing model limitations. So option pricing models do have limitations. All right, we're going to cover a few of those right here. In options pricing models, there have been assumptions made in order to mathematically model the price of an option. Different models have some different assumptions, but many of them overlap. In these graphs, we are using a binomial model to model out the prices of the Greeks and the spreads. In the real world, you might at times see slight differences or variations in the way a traded spread behaves and the theoretical behavior that we are reviewing here. So in other words, there's an options model and it spits out a price, right? But there is individual and option and underlying based skews that are placed into those models oftentimes. All right, we'll go into that a little bit more right here. Some of the assumptions are as follows. The direction of the underlying cannot be predicted consistently. Now, Mike and I know, and we know at Path Trading Partners, that that's not true. There are times when the underlying price can be predicted. For example, trending markets tend to continue to trend. Okay? So if you're able to say we're in a trending market, you can say with a decent amount of certainty that that trend will continue. All right? That's one of the weaknesses in the pricing model, or the limitations. It assumes that the direction of the underlying cannot be predicted consistently, and sometimes it can. The price of the underlying is log normally distributed. Okay, what's log normally distributed? It means that in a bell curve, all right, you may not know what a bell curve is, you may. But in a bell curve is essentially this. It's a curve in the shape of a bell where it says the majority of price will trade at the top to bottom of that bell. So if you imagine a bell standing on the ground, okay, and you imagine that to be a graph that represents price, okay, most of it will take place between the top of the bell and the base of the bell. Most volume will take place there, okay? That's what log normally distributed means. And pricing models tend to assume that the underlying will trade that way. Now, we know in truth that that's not the case. Okay, there are what we call fat tails in bell curves. They're also called leptokurtotic bell curves. You don't need to know that. But you do need to know that sometimes if you have an option pricing model, it won't necessarily match up exactly because of some of these limitations. So what do I mean by fat tails? An example of a fat tail would be this. If you have a population of people and the average person in that group, that population, is 6 foot tall. All right, that means the majority of the people are within a few inches of that 6 foot number. Now, as you go out the curve, so as you go down toward 5 feet and up toward 7 feet, you get fewer and fewer people in there. A fat tail means that as you get up past 7 feet and up below 5 feet, down below 5 feet tall, the number actually expands a little bit. That's what a fat tail is. So let's say you have a population of 100 people, 50 of them are 6 foot tall, okay? As you go down the curve, you get another, say, 10 to 15 people that are 5 feet tall and 7 feet tall, all right? And then you explode up to 20 on each side. Well, it wouldn't be 20 on each side, it'd be 10 on each side, but you get an expansion as you get toward 8 feet tall and 4 feet tall. Those are fat tails. That is essentially what happens in price. Okay, now pricing models tend to assume that the underlying is log normally distributed, and that's just not the case. Okay? The underlying price in any time period depends only on the price observed in the preceding period. In other words, it follows a perfect path. We know that to not be true. All right, most pricing model limitations assume that pricing is random. So they can put it basically on a curve like that, and that just isn't the case. It sort of applies to the point made above as well. Pricing models also assume that traders are risk neutral and indifferent towards risk. How many of you are indifferent towards the risk you take? I would say probably not many. And traders are not necessarily risk neutral. They're not always risk neutral in their thinking or their positioning. Okay? So that again is a weakness or a limitation in pricing models. And also, commissions and fees are ignored. Okay, so there are some limitations in the pricing model, but there has to be a pricing model in order to distribute prices on a regular basis. So these pricing models have limitations, but they exist, and the options are based on this. So I'm going to turn it over to Mike to go more into how the Greeks will help you kind of make sense of these things.
Okay, great. Can everybody hear me? Can you guys all hear me okay? All right. Fantastic. Thanks for that great introduction, Bob. And again, I'm going to stress that you don't have to understand every aspect of these. What I want you to take away is sort of the shape and sort of the overall way it looks, because that's going to be the most important thing. Knowing exact numbers are not going to be important. Knowing sort of how it reacts, like why we went over prior at the money, in the money, out of the money, you know, the strike price, the floor and ceiling strike prices, why we did all that was because you're going to see how the different Greeks react at sort of those key levels and the critical levels. And that's what I sort of want you guys to grasp onto and focus. So in order to do that, we're going to examine the underlying. This is a hypothetical underlying or a hypothetical indicative versus a 100-105 Nadex spread. We're going to look at it right now at 3 different points. We'll look at the underlying as if it was at 100. Sort of this is going to be a 100-105 spread. So the 100 we'll call the floor price, the 105 will ceiling price. So we're going to examine it at the floor price, in the midpoint, and at the ceiling price. And we're going to start laying this out so we can roll in the concept of the Greeks. And we can discuss intrinsic and extrinsic value at each point. All right, so here is our spread. Now we have 2 lines on here. The blue one, which is what it would look like at expiration. When it expires, the only thing left is intrinsic value. The green line is how it looks at 30 minutes to expiration. So the bottom scale going left to right down here is the price of the indicative or the underlying. The scale on the left-hand side, the vertical scale, is the price of the spread. So with 30 minutes left, when we're at the money, at the floor price, the spread is worth somewhat just less than 1. All right, if it expired there, we know at the money there is no intrinsic value. It's all extrinsic value. So if we hit expiration, the spread actually expires worthless. There's no money. You wouldn't make any money. If you put it on at 100 and you sat on it till expiration and it finished at 100, it would be worth nothing. But if there's time left, it's worth something because that's extrinsic value. Now as you climb up above 100, you have intrinsic and extrinsic value. All right, when it's at 101, it's going to be worth, with 30 minutes to go, somewhere more than $1. It's $1 in the money, but it's worth more than $1 because it still has time component. And you can see we've talked about the null point. We've also talked about it as the ceiling price before. You can see at the ceiling price before expiration, if let's just take a step back. At expiration, if you were to own the spread, Whoa. If you were to own the spread and it expired, it would be worth intrinsically $5 at expiration if it expired at the ceiling price. But before the ceiling price, with time left, it's not worth $5. This is where, if some of you know, you can capture time, because like it could be worth 105 and only worth $4. And over time it will approach, if the underlying does not move, it will get worth more and more and more as it approaches expiration, which can be seen. Here's the line at 30 minutes to go, here's the line when it expires. So it changes value over time, which Bob sort of alluded to with theta, and theta can be both positive and negative. All right, so let's take a look at this a little closer. So at $100, when the underlying is trading at $100, the spread is a value of about 0.95 cents. You can see that by these little lines. So if we go up from 100, we can see if we go across, it would be worth a little less than the dollar. At 102, if we go up to 102.5, the spread is worth about 250. It's right at the null point. Then at 105, the spread has a value of about 405. So if we know this corner piece right here is at 105. If we drop down, we see it's just about $4. We'll call it about 405. And again, we're not worried about the exact numbers here. This is to show you. So as the underlying went from 100 to 102, we see a certain increase of the underlying, and we see a certain increase of the spread. Let's take a look at those. So as the underlying moves from 100 to 102.50, the spread value moved from 95 cents to 250. The value of the underlying has increased by $2.50. The spread value increased only $1.55. You're going to learn real quick that that's actually the delta, as Bob was talking about. A delta, the underlying may move $1, the spread does not move that same dollar. This is an example of it. Now, as the underlying moves from 102.50 to 105, the spread value moved from 250 to 405. So the value of the underlying has increased by 250. The spread, again, has only increased by 155. And I want you to take one thing away from this. This is at a specific point in time. Remember, this is with 30 minutes to expiration. However, time's always changing. So this green line is also going to change slightly as every minute passes towards expiration. And it's going to be different with 60 minutes to go, then with 30 minutes to go, then with 15 minutes to go. So all this is like a snapshot and a point in time. Now let's get into the concept of delta. What we just looked at is a clear example of the concept of delta. Here's the definition again. Delta, the sensitivity of the spread price to price changes of the underlying. We just saw by noting in two different cases that the spread did not increase as much as the underlying given a certain timed expiration. Again, a certain timed expiration. But in both examples, the underlying moved, or the indicative moved $2.50, the spread moved or changed by $1.55. So please keep in mind as we go through all the following graphs that they are simply a representation of the Greeks and not an absolute value. Don't try to take notes and say, okay, with 30 minutes left, it always has to change like this. No, there are components. The time component is fixed, but time changes every minute, every second towards expiration. There's another component, though, that's modeled by the market makers, and that's implied volatility. And they can also change that at any given time based off what's going on in the indicative index. So you can't just say with 30 minutes to go, the value of a delta is always going to be this for this kind of spread. That's why I'm saying don't worry about the absolute numbers. I want you to take away the shape of the graphs and sort of how it affects the spread at different points.
Hey, Mike, if I could.
Go ahead. Go ahead, Bob. I think maybe Bob cut out for a second. Let me just finish this line and he'll pop back on. The absolute values depend on the volatility, the underlying price, the difference between the floor and the ceiling prices, and the time to expiration. So that's sort of the inputs into this model, and that's why you just can't write down all these values and take it away from there. All right. So here is what a curve of the delta looks like. Again, on the bottom horizontally, we have the price of the underlying or the indicative. On this side, this is not price, but this is the amount the price will change based off a $1 change in the underlying. So if we're at 100 and the underlying goes up essentially $1, you'll see the spread increase by 0.5. And again, this is at a certain time to expiration, which is always changing. If we're at 102.50 and the underlying goes up by $1, you'll see the spread change by, let's call it about 0.75. So you can see how the delta is changing. If we're down way below the floor price, let's say at 97, and the underlying changes at $1, the spread price will only change by under 0.1. We'll call it about maybe 0.8 at this given time to expiration. So key takeaways of the delta versus the underlying price. The delta of a spread is highest near the midpoint of the spread. We just saw that. Take a look. Near midpoint of the spread. Remember, midpoint was 102.5. So right here, look, the delta is the highest. Delta is the lowest below the floor price and above the ceiling price. Let's go back. Floor price 100. Delta's lowest. As it goes farther and farther away from the floor price, the delta drops. And as it gets higher and higher above the ceiling price, the delta drops. Remember, ceiling price 105. Delta keeps dropping towards 0. Well, the floor price keeps dropping towards 0. Delta rises as the underlying approaches the midpoint of the spread. Delta falls as the underlying passes the midpoint and approaches the ceiling price. So, delta keeps rising up until the midpoint and then it starts falling away. Major takeaways. Delta values, it's more important that you understand the key delta points we just examined than the absolute value of the delta at each point. Let's take a look at what different values of the delta means. If the delta of a spread is 0.5, or some people say 0.5 is the same as 50 because they turn it into, well, sort of percentage values. We're just going to leave it at the 0.5 for now. And it also changes for binaries because binaries we model in an absolute price difference based off the $100 at expiration. So, and we'll have a separate webinar coming up on the Greeks as applied to binaries, so stay tuned for that one. Right now, we're just talking about the Greeks as applied to spreads. So, if the delta of a spread is 0.5, then the underlying increases $1, the value of the spread will increase $1. If the delta of a spread is 0.8, then as the underlying increases $1, the value of the spread will increase 0.8 of a dollar. Now, take it the other way. If it falls by $1, the delta will then decrease the value of the spread, like that 0.5 or 0.8, depending on where we are on the curve. All right, so remember how I said it was a snapshot in time? Here's how the delta curve changes over time. So we have a 60-minute to expiration, 30-minute to expiration, 10-minute, 5-minute, all modeled by these different colors. So that's what I want you to really take away from this. As time changes, if price were to stay the same, the delta still changes. All right? As we get closer and closer to expiration, if you're like below the floor price it changes. The delta starts dropping away as you get closer to expiration. But if we're in the middle of the spread, delta actually increases as we get closer to expiration. So delta changes with time and can amplify or minimize the changes of your spread price.
Can you guys hear me now?
Yes, we can.
Sorry about the technical difficulties. What I wanted to say in the other slide, and what still applies to this slide, is I was talking to a Path Trading Partner student today, and he basically said, you know, I've got to admit the graphs kind of throw me right now. And I wanted to throw out there, as I'm sure a lot of you have grasped because we've been saying it since the first webinar, do not stress if you look at this graph and say, I don't understand why like this cartoon drawing of a girl's hair matters for what goes on with my spread. You will have a light bulb moment. The good thing about light bulb moments is that they happen. The bad thing about light bulb moments is they happen at different times for different people. You'll understand what these graphs mean if you listen to these webinars over and over again, attend our webinars, and talk to us more and more. The meaning of these graphs will help you trade better. But you're not expected to look at these and say, okay, I get it. I get what the blue one is. I get what the green one is. You won't. And that's very, 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 very normal. But once you understand the graphs, to go back to Stella's point, once you understand the graphs, you won't necessarily need to sit there and calculate things out. Okay, you'll understand the different sort of characteristics of the spreads at the different times with the different volatilities, and you'll be able to trade more successfully that way.
Yeah, but that's great advice to people, and we're going to keep reiterating that. So what I've tried to do here also, like as we have in the next slide, I'm going to try to summarize some key points. So as you're rewatching this, if you want to write some things down, like the key takeaways of delta versus time, if the underlying is near the midpoint of the spread, the delta will increase as time gets closer to expiration. So as you get closer and closer to that spread expiring, a price change in the underlying is going to have a greater effect of the price change of the spread nearer to the midpoint of the spread. All right? So as we go back here, look at 60 minutes ago, we have a delta. Let's just say the underlying is trading at 102.50. So we're right in that middle. With 60 minutes to go, we're somewhere just below 0.6. So every 1 point is a 0.6 move in the spread price. However, with 5 minutes to go, look, we're up here by 0.9. That's at the middle. That's a key takeaway. So that's something that as you learn and you grasp this, you don't have to understand all these lines, but as time approaches expiration, the delta gets more significant middle of the spread.
Hey, Mike, I just want to read a question because it kind of applies to you right here. If you're above the ceiling in a long contract, does that mean that it stays in that price until expiration or it decreases? I assume he's referring to the delta. You guys hear me?
Okay, if you're above the ceiling price.
If you're above the ceiling in a long contract, does that mean that it stays in the price until expiration or it decreases? Raphael, I assume you mean the delta. Do you think the delta increases? I'm not sure if that's what you're asking.
Is it the delta, or is he talking about the, if you're above the ceiling price, let's just take a look at first price, then we'll take a look at the delta. So we're above the ceiling price here. All right, with 30 minutes to go, the spread, let's say we're at about 1.0, maybe 1.06. The spread is worth, let's call it $4.50. If it stays there, let's say it stays somewhere above this level or at this level, let's just say price freezes essentially at this price level. As we approach expiration, the spread will increase in value, okay, towards that $5 mark. And as long as the price, so if the underlying remains anywhere above this 105, it can move around, but anywhere above this 105, with time left to expiration, the spread will be worth slightly less than 5. Now, if you're remember we went over the concept of in the money. Deep in the money, as you get way, way above that ceiling price, the spread is nearly going to be equal to that ceiling price. There's very little gap here. See, if we were trading up above 110. But if we're trading closer to that 105 mark, with 30 minutes to go, the spread price might be worth 405, 425, 455, depending on where we're sitting. And if price stays above that ceiling price, the time decay will be to our benefit, and the price will approach that 5. Okay? That's how it affects the price. Now, in terms of the delta, you see here's that 105. So if we're, let's just move to about 107. So we're about $2 higher than the ceiling price with the underlying right here. You see that a $1 change in the underlying only changes the spread price by 0.2. So the farther you get above that ceiling price, a $1 move of the underlying has less and less effect to the price of the spread. Okay, so you can sort of start marrying those two concepts together. So that's a very good question, how all these things, and there's moving parts, that's why we're going to keep reviewing these things until you do have the light bulb moment. So, where were we? All right. We've gone through all that. We were looking at how the delta was versus time, and the key takeaways that the underlying of near the midpoint of the spread, the delta will increase as time gets closer to expiration. So the spread price has more significant moves near the middle of the spread as we get closer to expiration. Below the floor price, the delta will decrease as time approaches expiration. Okay, because you have less time for the spread to do anything. Okay, let's say you're down here again at 97 and it needs to be in the money. It's not going to be worth anything if it expires down here below the floor price. So changes with time, with little time to go, with 5 minutes to go, a $1 change going from 97 to 98 only affects the spread price minorly because there's not a lot of time left for this to get in the money. So the spread does not increase. However, when you are in the money close to the middle price, a $1 change to the underlying has a much greater effect on the spread price. And the same as we just talked about the ceiling price. If you're way in the money above the ceiling price, a change, a $1 change to the underlying does not have an effect. But as you go back towards that ceiling price, because remember, if you drop below that ceiling price very close to expiration, the spread's going to lose money nearly at a 1-to-1 level with very little time left. Why? Because with 10 seconds left, essentially, you know, that spread, every dollar change in the underlying is going to nearly change the price of the spread $1. So with 10 seconds left, if that underlying dropped from 105 to 104, essentially the underlying or the spread is going to only be worth 104 or $4 at expiration. So that's how the delta affects it over time.
Hey, Eric, I assume that Mike just answered your question, but can you correct me if he didn't? Eric asked Mike, is that less and less effect and less value, or just less effect? I think you just answered the question with that little. So does the value of the spread lose value when it goes way into the money to the right? That's Eric updating his question.
When it goes way into the money, the spread. I'm trying to think. Let's see how.
So this is a graph on the delta.
This is a graph on the delta. So when you're way above, again, let me go back to this other chart. When we're way up here, the value of the spread is not, let's say we're trading at 108. Now, with 30 minutes to go, when it's trading 108, maybe the spread is worth intrinsically $4.80, okay? So if it stays up here at 108, the spread's actually going to increase in value because when it expires, it's going to be worth that $5 as long as we're above 105. So you're actually increasing. What's decreasing is the value that the spread will have. So as you get higher and higher, each $1 change, if we're at 108, each $1 change of the underlying only changes the spread value like at let's call it at this time at 0.9, okay? And then if we take that a little step further, as we get very close to expiration, let's say with 5 minutes to go, each $1 change of the underlying only affects the spread maybe 0.2. So if you were to drop let's say with 5 minutes to go, we were trading at 108. Let's say the spread price was worth 490. If all of a sudden the underlying dropped to 107, that spread price might drop from 490 to only 488. Okay, it's not going to have that big an effect because it's so far in the money above the ceiling price. However, that same drop, if you were in the middle of the spread, would have a drastic effect. If we're trading at 102.5 and now we drop $1, that spread is essentially going to drop 0.90 cents in value. And I'll keep going over this because the light bulb moment will come. All right, so now.
Those are really good questions, guys, by the way.
Yeah, they're great questions. Delta versus volatility. We just looked at time. Now, volatility, implied volatility can also change, as we talked about. So, as volatility changes, now we can start thinking about this logically. Just as time, well, you know what, the delta was not as extreme with more time to go. Why? Because there were more outcomes with more time to go. With 2 hours to go in a spread price, there are many more things that can happen, right? Because this price can move around a lot in those 2 hours. Think of volatility the same way. With 40% volatility, that means the market is more likely to move a greater range of prices. More outcomes can happen, so the spread price will not change as much when we're in the middle of the spread price. So when we're at 102.50 with high volatility, the price of the spread is not going to change as much for every $1 change the underlying. Why? Because there's more likely that the price is going to move around and there's more possible outcomes. However, if we're down here below the floor price and we're out of the money, higher volatility actually helps us. Why? Because there's a greater chance that it could end up in the money. All right? Just as if we're at above the ceiling and we have greater volatility, it has, if we're long this spread, it has a greater chance of hurting us because it could drop back in the money. Versus if all of a sudden volatility drops, let's take a look at this. If we're below the floor price, with 40% volatility, we could end up, hey, great, this market's whipping around, it's moving, there's a lot of possible outcomes, this spread could end up more likely in the money. However, so that's why you have a higher delta. So every one move in the underlying is like, we'll call it 20%. And again, this is at a point in time. However, if volatility all of a sudden dies, let's say we're waiting for a news report. The news came out and the market just, hey, that was nothing. That was nothing. The market just shrugs it off. And now volatility. I know you guys, if you've been trading and seen this, where all of a sudden your spread that was moving in price just really just drops like a rock. So volatility dies. Look what happens to the curve, because now at 10%, there's a lot less likelihood that your spread can end up in the money. So a $1 price change of the underlying is only going to move the spread price minorly compared to that higher volatility. However, if you're in the money, like near that middle of the spread, and volatility decreases, that means there's not a lot of likelihood it's going to deviate from that level. So now any move in the underlying has a greater effect on your spread price because it's more likely to stay closer to that value, so it's actually going to impact the spread price more. Again, there'll probably be some questions on this, but you have to start thinking about it in terms of more time, and we're going to get into this in another slide. This is going to be really cool. More time and volatility are very similar because it gives more options to happen. But you have to realize that where you are in the spread price can benefit you or hurt you. That's really the takeaway I want you to get right now. So key takeaways of delta, that should say delta versus volatility. If the underlying is near the midpoint of the spread, the delta will increase as volatility decreases. Why? There are fewer options that can happen. If the underlying is below the floor price, the delta will decrease as volatility decreases. Why? Because volatility, it's less likely it will be worth something. There's less possible price, and if the price is, out of the money, it's not very good for you if volatility drops. Now, if the underlying is above the ceiling price, the delta will decrease as volatility decreases. Think about this. Let's say you're long the spread, and all of a sudden it's above the ceiling price. You actually love volatility to decrease. Why? There's less likelihood that it will drop below the ceiling price again. It helps you. If the markets go to sleep and your spread is in the money or deep in the money, you're very happy at that because it's most likely to stay there. Take a look at these two. Delta versus time and delta versus volatility. They look really similar. So I want you to just focus on the shape, not the values, but the shape. And this is how things change, but you can see how they look very similar. So key takeaways of time and volatility. Many of the graphs of the Greek will look similar between time and volatility. An easy rule of thumb to remember: at more time is similar to more volatility. Think of it this way: if there's more time until expiration or greater underlying volatility, more possible outcomes are possible and affect the spread in similar ways. All right? And depending on where you are in the spread is going to determine the effect it has. It's going to have a different effect with more time to go or more volatility if the spread is trading above the ceiling price or above the floor price, closer to the midpoint, than it will on either if you're below the floor or above the ceiling.
And Mike, Raphael is asking if volatility is similar to volume, and I'm wondering if that's your question, Raphael, before we go into it too much. The actual wording of the question is the volatility is similar to the volume, question mark. And what I would throw out there, Raphael, is if you're struggling a little bit, and this is not unusual, with understanding what volatility is basically price expansion. So if you have something that's moving very slowly, volume isn't necessarily the main factor, but it can be a factor. Volume can push price ranges out. So if you have crude oil and it's been trading between 37.50 and 38 all day, and all of a sudden in the exact same time frame, like let's say in the last hour, it traded 50 cents, okay? And then in the next 30 minutes, it trades $1.50. That is sometimes happens due to volume, but the price range has blown out. It's gone from 50 cents in an hour to $1.50 in 15 minutes. That's an increase in volatility. I don't know, Mike, if you want to add to that.
Yeah, and volume and volatility aren't necessarily correlated, because you can have huge volatility, especially in fast market conditions, and there's very little volume getting done because price is changing so fast. And you can also have very low volatility and very high volume in conditions, okay? So don't always equate volume and volatility. Volatility is more like Bob said, the rate of price change over a period of time. All right, so we've sort of gone through delta, and now we're going to get into gamma, and we're going to quickly examine the principle of gamma. It's more important that you understand delta, but I want to, for the point of completeness, just like everything we do, I want you to at least get exposed to the concept of gamma. The definition of gamma, again, is the sensitivity of the delta to the price changes of the underlying. So a great analogy is to think of delta as velocity and gamma as acceleration. I could be going 50 miles per hour, and depending on how hard I press the gas pedal, that will determine how fast or slow my velocity changes. So my acceleration will determine how fast I get from 50 to 60, or if I'm braking, how fast I will go from 50 to 40. Don't get too hung up on gamma. We are mainly including it for completeness. So here's the graph of gamma. All right, looks very different than delta. You can see now at this point it has negative values built in. It has positive and negative. It goes above and below the zero line. Again, across the horizontal is the price of the underlying. all right? And the values on the vertical are how much it affects the value of the delta. So if we were trading at 100 and the underlying moves $1, we already saw, you know, let's say the delta was worth 25.25. Well, the gamma, if we were there and we moved $1, that means the delta would increase by 0.17. All right, so we're not talking about any price changes to the spread. We're talking about changes to the value of the delta. That's why there was a delta curve. And when I lay these next to each other, you'll start to see it. It's easier to explain. But the brief key takeaways of gamma versus underlying price. Gamma is positive and increases as the underlying price approaches the floor price. These are the key takeaways. Gamma is positive and decreases as the underlying price approaches the spread midpoint. As the underlying price passes the midpoint, gamma turns negative and continues to decrease. Then as the underlying passes the ceiling price, gamma is negative but begins to increase again. That's easier to see with the graph. So let's take a look at this. Here we have the delta at a point in time and the gamma at that point in time. So you see how as we approach the value of 100, the gamma keeps increasing. Well, you can see the steepness of the delta keeps increasing as we approach 100. So the gamma is, as we approach it, the delta is getting steeper and steeper because the gamma is adding more to the delta. Now, as we pass the floor price and go to the midpoint, the delta starts slowing down. It's still increasing, but the rate of increase is not as much. You can see that by this curve falling off. So it's still giving a positive value. It's still adding to the delta, but it's not doing it in as fast. My acceleration is decreasing. The car is still accelerating, but it's not getting there as fast. Meaning I got from 50 miles per hour to 60 miles per hour in 10 seconds, but now to get from 60 to 70, it's actually taking me 20 seconds. When we go past the midpoint, another key takeaway, you see the gamma goes negative. Now it's actually subtracting from the delta. So the delta of my price spread is not going to move as fast. So when I was at 102.5, and the delta was adding 0.75, so every $1 change in the underlying changed the spread by 75 cents. When I'm up towards the ceiling price, it's going to change. It's going to only change at 0.5, and as I keep going beyond, it's going to keep decreasing. That's because this gets negative. However, as we get deep in the money above the ceiling price, you can see the rate of decrease starts slowing. So now I'm still decreasing the value, it's just not as fast. You can maybe think of this in terms of braking and slowing the car. So as I pass the midpoint, now I'm actually slowing down, okay? And this is the rate of slowing. Again, gamma versus time. Time is always changing. So this is just a graph, and this is getting more esoteric, and I don't expect anybody to really get this the first time through, and it's, again, for point of completeness. But you can somewhat see that as time changes, as we approach expiration, depending on where you are at the spread, your gamma values change. As we approach expiration and we're near the floor price, or right at the floor price, gamma actually increases delta a lot more as we get close. Why? Because as you get close to expiration, if you're right at the floor price, and this spread could be either in the money or out of the money, every $1 change in that spread is going to affect the dollar a lot close to expiration. However, with a lot of time to go, 60 minutes to go, it's not going to affect it as much. Why? Because more outcomes are possible. Again, if you're right at the ceiling price and long this spread, it's going to have more effect closer to the delta, closer to expiration. Why? Because there's more potentials that happen, so that delta can move around faster on a one-to-one basis with the underlying. That's the key takeaway I really want you to get. Just the delta changes depending on where you go as you approach expiration. And then you at the midpoint, that's where your acceleration changes from positive to negative. So key takeaways of gamma versus time. As the time to expiration decreases, the gamma of the spread decreases if the underlying is significantly below the floor price. As the time to expiration decreases, the gamma of the spread increases if the underlying is between the floor price and the midpoint. As time to expiration decreases, the gamma of the spread decreases if the underlying is above the midpoint but below the ceiling. And as time to expiration decreases, the gamma of the spread increases if the underlying is significantly above the ceiling price. Again, point of completeness. You might have to watch this a number of times or review this concept. And this is why we're going to be around to help you guys. If you really want to understand gamma, again, it's not as important. Delta is more important. As with delta, the absolute value is not necessary to know. It is more important to understand where gamma is the highest and lowest, positive and negative. Now, if the underlying price increases by $1 and the spread is gamma of 0.2, it means the delta of the spread will increase by 0.2, not the value of the spread. Again, the gamma is modifying the delta. It has nothing directly to do with the spread price. The delta modifies the spread price. The gamma modifies the delta. If the underlying price increases by $1 and the spread is a gamma of negative 0.1, remember, gammas can be negative, then the delta of the spread will decrease by 0.1. Again, not the value of the spread, but the delta will decrease. Again, gamma versus volatility in here for the point of completeness. As volatility goes down, the gamma has more effect on the delta near the floor and near the ceiling. Why? Because there's less possible outcomes. So your delta really you sort of get a lot of bang for your buck, either positive or negative, when the spread is trading at the floor or the ceiling and your volatility goes down. Why? Because gamma really starts to amplify the effects of delta. And always, it does not near the midpoint. As time and volatility looks, it really doesn't matter where the volatility is because it all crosses from positive to negative. So generally, gamma behaves the same in reference to decreases in volatility as the time to expiration gets closer. This is most extreme at the floor and ceiling prices. All right. So I sort of went through gamma a little quicker. Because it's not as important, but you can take the time. This is recorded. You can watch it. You can look at these graphs. Really, I'd rather have you focus on delta because you can capture most of the understanding just from the concept of delta.
John Woods asks, so in actually trading spreads using path strategies, we'll be watching these Greek values on a chart so we know when to act on our trades getting in and out. Go ahead, Mike.
No, that's, again, remember I said don't worry about the points. What I want you to know, what I want your takeaways to be, because here's the key aspects, and maybe I can get back to some of these other. Let's go back to delta real quick. Let's go back to a nice. What I want you to understand, all right, delta versus time. So if you know, let's say a strategy tells you that you want to maybe, there's high volatility, or there's a lot of time to expiration, and the extrinsic value of the spread is really pumped up. Where might I want to enter it? Well, let's tie all this together. If I enter it and there's a lot of time to expiration, there's going to be a lot of extrinsic value, below the floor price. It's all going to be extrinsic value. However, where it crosses at the null point, you're going to really just be intrinsic only. So you're going to know the effects on that. Whereas if I'm at very low volatility and I know how the delta is going to affect my spread, there are times I'm going to want to enter near the floor price for a long spread. there's going to be a times where I'm going to want to enter actually near a ceiling price for a long spread, depending on volatility and time conditions. So that's what I'm trying to get across. So once you understand really, that's why I sum stuff up in key takeaways, like key takeaways of delta versus underlying price. Spread is on. If I go to market is, you know the price is near the midpoint of the spread. You're also going to know delta is highest. Delta is lowest below the floor price and above the ceiling price. So your spread is not going to move as much as the underlying, especially below the floor price and ceiling price. These are the kind of takeaways I want you to get. And when we explain a strategy, or because you can have different entries for any given strategy based off the conditions of the marketplace. You know, if there's high volatility, let's say you have a target and there's high volatility and you want to know, okay, high volatility, and I know where my target is. Now I know when there's high volatility and I have a target level and I can, all right, I can pick out the exact spread I want and I should enter maybe near the midpoint. However, low volatility and we're trading above a key support level and I can actually put on, and we're going into a slow time in the trading day, I can actually put on, given those factors and a bunch of things that align with the strategy, I can put on a spread near a ceiling price, a long spread, in order to capture that time decay because I'm counting on the volatility staying low and the time as it goes to expiration, I'm actually capturing that intrinsic value. Why? Because in the next sessions, we're going to be going over theta and vega and how that's going to affect it. So once you assemble all these Greek prices, you can really start to understand why you're doing things and why you're trading certain spreads, instead of Bob and myself just saying, oh, here's what you want to do. When this happens, here's what you want to do. Don't worry about it. Just do it. That's not what we're here to do. We're here to make you well-rounded traders, and over time, you're going to get more and more of these concepts. And once you really get these concepts and the light bulbs go off, you're not going to be dependent on us. We could teach you any strategy, or you could learn any strategy from anybody and know the best spreads to put on, the best times to put on those spreads, the best places to put on those spreads. That's what we're getting. So you're not dependent on us. You're actually independent of us or anybody else and can take anybody's strategies and optimize them and for trading Nadex, whether they're binaries or spreads. That's what we're trying to get you guys to.
One of the things we want you to focus on, John, and everybody else who's listening, is understanding what you're trading and understanding the Greeks in the spread specifically, and the binaries as well, but in the spread specifically. It's more going to, at least initially, tell you when not to put a trade on. One of the things that happens to a lot of traders is they sit there and they think, if I don't put a trade on, and John, you know what I'm talking about, if I don't put a trade on, I can't make money. But if you put a trade on at the wrong time, with the wrong volatility, with no concept of delta and no concept of time decay, and you put it on just because you're at the floor or at the ceiling, you're going to lose more often than you win. So understanding these concepts initially will not take the form of saying, okay, good, the delta's here, I'm going to get out. It's rather going to take the form of you saying, okay, with my particular strategy, volatility is too high at this level, or there's too much theta decay in this particular trade, and you'll be able to weed out the bad trades. For most people, that's really all they need to do to get to break even or slightly profitable. And then from break even to slightly profitable, life-changing is the next step, and oftentimes only takes a few tweaks. And please don't think I'm exaggerating when I say life-changing. I'm not talking about, you know, a 5-bedroom house on the ocean and 10 cars. I'm talking about changing your life to where you failed all this time and now you're successful at whatever level each individual can be successful at. Oftentimes, getting to break even is the #1 thing you should be trying to do. And understanding the Greeks, and thereby understanding the structure of the spreads, you'll be learning the best times to impart your own strategy or strategies that Mike and I teach you into the markets. That's what's the most important thing. It's often more important for traders to learn when not to trade than it is to say, okay, the Greeks are here, now I'm going to switch to this strategy. Well, volatility's up, so I'm going to switch to this other strategy. Well, now vol's down, my delta's moving, I'm going to switch to this third strategy. That's not what we want to teach you to do. We want to teach you to understand what you're doing so that you can get that one thing right that you're already good at. You're already good at something or you wouldn't be here. You already know that you're close or you wouldn't be here. So what we're here to do is hold your hands through the structure part, through the stuff that other people don't tell you, and say, look, this is how this stuff works. So now look at your strategy and tell me what you think and tell me when you should do something. That's why we covered this overview of the Greeks. We're going to have another one of these next week. Okay, and just as a side note, because I actually have to take off for a meeting, but Mike's going to stick around for questions. But what we have to do next is we have a Path Trading Partners webinar. It's not a Nadex webinar. It's a Path Trading Partners webinar that you can sign up for on our website. And then we've got another Nadex free webinar on the 15th to finish off the Greeks. Okay, so that webinar is same time tomorrow. You can sign up for that one at Path Trading Partners. And then you've got to attend the next one through Nadex as well. Because honestly, all we're trying to do, as Mike kept saying, is make you guys well-rounded traders. We've taught a lot of traders, over 7,000 between the two of us. And the vast majority of the successful ones do not finish their careers trading the specific strategies Mike and I teach, but they build the foundation through us. And then they're able to analyze everything else that's out there. So pathtradingpartners.com to go to tomorrow's webinar, which again, that's not a Nadex webinar. I want to stress that. Okay, it is about what we do at Path. All right, we've got a Nadex webinar next week on the 15th at 4 o'clock.
And the one tomorrow, it's a Path Trading is a free webinar. So, you know, we're sharing more and more information of aspects of how things work and our experience as traders with how things work.
Eric, before I jump off this, I'm sorry I did not get that voicemail in time. I apologize for that. So next time you're in town, please do reach out again, and I'll make a point to meet up with you for that cup of coffee. So, guys, I got to take off. Mike's sticking around for questions. Chip and Nadex, thank you again.
All right, guys, let me just go over the recap of the first session. And we divided this. It's a good thing we did divide this into 2 sessions, else we'd probably be here all night. But we've gone through sort of an overview of the Greeks, and we looked at delta and gamma. We investigated how delta and gamma react to time and volatility. All right, there's a lot of information contained in just this first part of the presentation. So take time to review it. You know, it will get posted, and you'll be able to view it through the Nadex links and on their channel, so you can watch it however many times you need. Also, we're around at Path Trading, so you can come and ask us questions. You know, send us questions. Go sign up for our free webinars, because there's going to be more and more stuff offered, and you'll be able to ask questions there about concepts. We're here for you guys to build a solid foundation as Nadex traders. And right now we're covering the spreads. We're going to be doing the same stuff for binary. So for all you binary traders too who want to know how the Greeks affect it and why the binaries react certain ways, we're going to be getting into that. Because once we baseline all this and once we review it multiple times with you, it's just going to make you better traders. Some of you may already have strategies you like and you're using. Great. This is going to make you a better trader. That's our whole goal here. So next time we'll finish covering the concept of theta and vega, and theta is that time decay and vega is volatility and how volatility specifically changes over time. So we looked at volatility and time as it was applied to the delta and gamma, but there's also the volatility component and how it affects the spread price, and theta and how it directly affects the spread price, and not just how time and volatility affect the delta and the theta. The delta and the gamma. That's the difference. Well, next time we're going to look how time and volatility directly affect the spread price. And we know, again, that this is advanced information and it will take some time to absorb it, which is why we are taking our time and teaching it. We're not going anywhere, guys. We're here. So please rewatch this webinar and reach out to us at Path Trading Partners with questions. All right? We have support links. You don't have to be signed up for anything. If you say, I'm sort of confused on this, because maybe we'll develop a whole webinar for Nadex. If enough people come up with those questions, we'll say, hey, a lot of people have that one question or this group of questions. Let's teach that to you guys. Let's reach out to Nadex and let's teach it, because they want you to have this information. So if you want all our different things, you can follow us on Twitter at path_trading. You can like us on Facebook, all the social media stuff, and you can visit us on our website. And, please sign up for stuff. We do either through Nadex or our own stuff. We do free and paid things, but you won't know what we do unless you sign up. So, Chip, any more questions?
It looks like the questions have settled down here. But the good news is you're going to be doing it again, the second session next week on December 15th. I will try to get this recording up as soon as possible. You can get it on if you look in the webinars section under the Nadex homepage, under the archives section, you'll be able to watch this recording of session 1. Currently, you guys have done a total of 3, I believe, so far, and they are all located right there. So these are really important concepts for everyone to understand. It's actually the building blocks that you need to make great or good trading decisions or an educated trading decision is what it is. So, be sure to sign up for the next session. These guys are doing something. You said tomorrow, Mike? Is that correct?
Yeah, we're doing one tomorrow.
Okay.
Different aspects of strategies,
Right.
and this starts tying in different aspects of strategies for people. So
right. Okay.
And how it works with Nadex products.
Okay. Well, good. So excellent stuff. And Mike, thanks again. I thank Bob, but he's left. But another great webinar. So thank you all. Unless I see another question.
I just want to thank everybody. I know some of this is challenging, and thank you for sticking with us and spending the time to